Hello there, welcome back to this series. This is part 2 of Analysing Financial Statements. It's a brand new series on my YouTube channel. If you've joined the series here, then please go and find part 1. I'll put a link in the description below. Watch part 1, then come to this video. Part 1 is very important. It goes through what to expect from this series and what you should know before taking this series. In part 2, which is this video, we're going to go through some formulas that you can use to analyze financial statements, and we're going to look at some example accounts. I have a set of limited company accounts. They're dummy limited company accounts. It's totally fictional. They do not represent a real life company, but the figures stated in these example accounts are very realistic. They could be what you could see on a set of real company financial accounts. So we'll have a look at them in a moment. What I can do is let me just minimize this. So I've got my Excel to the right to take some notes, and you can still see the slide to the left. And then right here, I have a set of financial accounts. So a few things to note about these financial accounts, first of all, is there are usually 3 or 4 pages before the profit and loss, which usually shows before the balance sheet, but there's usually 3 or 4 pages before the profit and loss that usually has statements and information about the company. So we have a cover letter here which says the accounts are for 30th of April 2019 with the name of the company, example company limited, and the registration number at the top right here. Now, this is not going to be identical for each limited company set of accounts, but this is usually what to expect. You may then have information about the accountants that compiled the accounts. So here we have false accounting company limited with a false address. We have a table of contents, some information about the company such as the director or directors, the registered address, registration number again, and then some information about the company and the accounts. Usually somewhere stated on this page is what the company actually does, like the industry that it's in, what it does to generate money, and then some more information about the directors. So once that's all out of the way, you'll then move on to the profit and loss, followed by the balance sheet, and then followed by some notes about the profit and loss and balance sheet. Usually these notes contain broken down figures that have been stated on the balance sheet. For example, you'll have an asset figure. In the notes, you'll have how that asset figure has been calculated, which is generally the asset figure from the previous year, plus any additional assets purchased in the year, minus the depreciation. That will give you your asset figure 699, which is then posted to the accounts. Now, some of this is quite basic stuff. This series isn't about compiling a balance sheet or compiling a profit and loss statement. If you want to learn those things, then head over to my website and take some free courses, freebookkeepingaccounting.com. So that's just a quick overview of the accounts and what to expect. Now, you'll see that on a set of annual accounts, you have the year stated. So this is for the year ended 30th of April 2019. So we have the figures for the year stated, and we have figures for the year previous. So we have figures for 30th of April 2019 and also 30th of April 2018. And that's the same with the balance sheet here. We have 2019 and 2018. Now, going back to my slide over here, if we go to the next slide, comparing accounting information, this is the first thing I really wanted to emphasize when analyzing financial statements. It can really help with the analysis if you have accounting information to compare accounting information to. So with our accounts, if we've got profit and loss and balance sheet figures for 2019, We've also got the 2018. That's really going to help with our analysis. And you'll see how this works later on, because in part 3 of this series, I'm going to really start analysing these accounts, and you'll be able to see just how important it is to be able to compare information, as well as other things that I'll cover in part 3 of this series. So to be able to compare accounting information. Now, if you're not looking at annual accounts, let's say you're looking at the previous quarter. If someone has compiled management accounts for the previous quarter, then you can compare that quarter to the quarter previous. Or if the company's been trading for at least a year, you can compare the previous quarter to the same quarter from the previous year and the previous year before that. If you can compare accounting information, it will really help with analysis. Now, the only time you will not be able to compare accounting information is if it's a new company. If the company has only had one quarter, there's no quarter previous to compare it to. Or if it's only been trading for 1 year, you won't have a previous year to compare to. If that's not the case, then there will be accounting information that you can compare current figures to. Now, if the company has been trading for only 1 quarter or 1 year, you can still analyze the accounts. You just can't compare. Comparing is part of the analysis. It's not the analysis. So don't think that your company's only been trading for a year, so I can't analyze the financial statements. Of course you can. This is just part of the analysis. Now, if you don't compare to previous years, or if you do compare to previous years, you can also compare to industry standards. And we'll come back to this a bit later on in part 3 when I analyse this set of financial accounts. So you can compare to previous accounting information from the company, the entity, but you also can compare to industry standards, such as competitors and figures released for the industry. You can compare to those things too. So that's the first thing I wanted to emphasize when analyzing financial statements. And then the next thing is our first formula, which is gross margin. And we're going to start off very easy. We're going to look at margins first of all. They're the most basic ways to analyze a profit and loss statement. But these formulas will get a bit more complex as these slides go on. So gross margin. So just a reminder, gross profit is sales minus cost of sales. So if I go to the profit and loss here, you can see our gross profit is stated here, which is the sales, the turnover, minus the cost of sales, or purchases, or distribution, whatever that cost of sales is, gives us our gross profit. So gross margin, first of all, gross profit equals sales minus cost of sales. You should know that. If you don't know that, then I really suggest you go and take some basic free bookkeeping and accounting courses on my website and learn this stuff. So what is gross margin or gross margin percentage? We want to know percentage-wise what this gross profit actually is compared to turnover. So every dollar of sale, or every pound of sale, or every euro of sale, what percentage of that is going to be gross profit? And that's what gross margin does. So if we look at this formula, it's gross profit divided by turnover, or sales, times by 100, gives us our gross margin percentage. So let's bring up the notes here and let's type this out. If you've got pen and paper, then please follow along. So if we do gross margin, and what I can do is make this a lot bigger, just so it stands out on the video. So gross margin, it's gross profit divided by turnover, or sales, or revenue, times by 100. Okay, so if we bring up the set of accounts, I can bring up my notes at the same time. So our gross profit is 746,437. So we have 746,437. Let's put a comma in there just to make that a bit clearer. We want to divide that by the turnover, which is 3294443. Once again, let's put some commas in here. and then we want to times by 100. That will give us our gross margin or gross margin percentage. So let's bring up a calculator and let's do this. So let's do 746,437 divided by 3294,443 equals this, times by 100 is 22.66% if we're rounding up. So 22.66%. That's our gross margin. So every dollar of sale, 22.66% of that, so just under 23 cents of every dollar, or 23 pence of every pound, or 23 cents of every euro is a gross profit on average. Okay, now I'm not going to go too much more into detail about this, because in the third video we're going to really look at this in more detail and what this tells us about the business. But something to mention at this point is a gross margin of 25 to 50% is considered healthy. Now that will change per industry. For some industries it's totally normal to have a 20% gross margin, whereas some it's totally normal to have 90%. But just as a rule of thumb, 25 to 50% gross margin is considered healthy. How about net margin? So we've done gross margin. How about net margin? So net margin or net margin percentage. Well, let's just remind ourselves what net profit is. So net profit equals gross profit, which we've just had a look at, minus expenses or overheads. So let's bring up the accounts again. Our net profit is down here, 64,317. That is the gross profit minus any expenses and overheads. That gives us our gross profit down here. Once again, this is very basic accounting. So if we bring up the notes again, our net margin calculation is very similar to the gross margin. So net margin is net profit divided by turnover times by 100 gives us net profit percentage or net margin percentage. Same calculation as before, but instead of gross profits we have net profit divided by turnover times by 100. So let's bring up the accounts and our notes. So the net profit is 64,317. We keep forgetting to put those commas in. The turnover is 3294443 times by 100. So let's bring up the calculator. 64317 divided by 3294443 times by 100. The net profit percentage or net margin percentage is 1.95%. So just under 2%, 1.95%. So every pound that we are taking in sales, then just under 2 pence of that is actual profit, net profit. Okay, now if I'm going too quick for you, then obviously feel free to rewatch the video. You know, it's totally for free, just keep rewatching it if you need to. Let's move into some other ratios and formulas now. So current ratios, this is current assets and current liabilities. So we're going to move away from the profit and loss statement for the time being, and we're going to move down to the balance sheet, which shows fixed assets, current assets, and liabilities, as well as equity for the company. So this is a typical balance sheet, and once again we have the current year and the year previous. The figures are stated for both. So bringing up current ratio, so current assets and current liabilities. Now the whole point of current ratio is to see if the current assets of the company or entity meet the obligations of the current liabilities. So if we were to look at this in real layman terms, if the only asset of the company was £100,000 or $100,000 in a bank account, and the only current liability was a loan from the bank of £50, £50,000 or $50, so we'd have 100,000 in assets, current assets, 50,000 in current liabilities. That will produce a good current ratio because the assets meet the needs of the liabilities. So the concern is with current ratio is if the liabilities are actually larger than the assets, then the company might be struggling to meet its financial obligations, to meet its liabilities. A company always wants to have a higher amount of current assets than current liabilities. So the formula is current assets divided by current liabilities gives us the current ratio. So let's have a look at this. So let's bring up current ratio, which is current assets divided by current liabilities. Now the ratio will be displayed on the calculator. You'll see that as a rule of thumb, 1 is the starting point. So if you get 1 on the calculator, that means the current assets perfectly, if that's the right word, perfectly meet or just meet, I don't know how you want to look at it, but the current assets meet pound for pound or dollar for dollar the current liabilities. So if it's under 1, then the liabilities are generally higher than the assets. If it's over 1, that's what you want. We want assets to be higher than liabilities. So let's bring up this and this. So the current assets of the company are here. So we have debtors at 431,154 and we have cash at bank 62354. What are the current liabilities? There's just one, which is creditors at 418,842. Okay, so we want to add these together, which is 493,508, 493,508, and we divide that by the liabilities. 418,842 gives us 1.17. So that's the ratio of assets to liabilities. As mentioned, if it was showing as 1, that means the total assets, current assets, meet the total current liabilities, pound for pound or dollar for dollar. There is no real ratio between the two. They cancel each other out. If it's below 1, that's a real warning sign because the liabilities of the entity outweigh what the company actually has in assets. Okay. Once again, if this is too much for you, then please just slow it down, watch this video over again. So what's the next ratio? It's the acid test ratio. Now this one's a bit more famous, but it's pretty much the same formula. So acid test. Now what acid test ratio does, it does liquid assets and current liabilities. So it takes this current ratio a step further, where it's not so much interested in just current assets, but only assets that are liquid, assets that are either cash or can be easily turned into cash, because it wants to ensure that the liquid assets, those that can be easily generated as money into the bank or already money into the bank, can meet the financial obligations of the liabilities. So let's say all the liabilities of the companies, the bank loans, the creditors, tomorrow said, look, you have to pay us today, otherwise, the world's going to end or whatever. Could the company do that? Does it have the cash available to be able to do that? So this ratio focuses much more on liquid assets rather than current assets. But the formula is the same. So instead of current assets, it's liquid assets divided by current liabilities. And once again, you'll have a ratio where 1 is the starting point, really. Anything below 1 could be dangerous. Anything over 1 is seen as positive. Now, the thing with these accounts is that the current assets are all liquid assets. We have debtors and we have cash at bank. If there was other current assets here that weren't so liquid, we would not use them in the acid test ratio. Okay, days sales outstanding. Now this is an interesting one, and I need to make sure I take my time with this. Let's bring that up. So we have days sales outstanding. Sometimes it's just abbreviated to DSO. Now this measures the average debtor payment days. So this is how long does it take this company's customers to pay them? How many days does it take? Now, as a rule of thumb, anything 30 or less is considered healthy. Most companies have payment terms of 30 days. Anything over 30, then you have those warning signals start to flash. It could be considered unhealthy to have payment terms or debtors paying you over 30 days. So it says the average debtor payment terms. This is the average amount of days it takes a customer to pay the business. Now, the formula is debtors, let's try it again, debtors balance divide by total credit sales times by 365 days. That gives us our average days. So if we have a look at this, so bringing up my notes, this is using both the balance sheet and the profit and loss. So the debtors balance is 431,154. Let's put our comma in there. What's the total credit sales? I'm assuming that all sales were credit sales, which they are for most businesses, unless you're in retail or something like that. So that's the total credit sales. So we have debtors balance, total credit sales times by 365. So let's have a look at this on the calculator. So we have 431,154 divided by the sales, which is this, times by 365 equals 47, almost 48 days it's taking customers to pay their bills. Amazing. Hopefully you can start to see how from a set of accounts you can start telling quite a bit about a company. Most people would not know that from a balance sheet and from a profit and loss that you could actually be able to know on average how long it's taking customers to pay. Who would know that? You know, that formula is fantastic. And we have another fantastic formula here, which is accounts payable turnover. So accounts payable turnover. Once again, sometimes this is abbreviated to APT. Now the formula for this is creditors balance divided by total credit purchases times by 365. Now the thing with accounts payable turnover, it's the opposite of days sales outstanding. What accounts payable turnover is how long is it taking the company in days to pay its creditors. So if you think of this debtors formula here, it's the opposite. It's to do with creditors. How long is the company taking to pay its creditors? This one, how long are the customers taking to pay the company? Now, the only thing with this formula is it's not so easy to work out what the total credit purchases are. If I bring up the accounts, the creditors balance is here. So 418,842. Let's put that comma in. What's the total credit purchases? We don't know. There is a big bunch of admin expenses here. There's also 2.5 million of cost of sales, but we don't actually know which of these purchases and expenses were purchased on credit. We don't know, so we can't do that formula. So this one usually requires further information. Okay, now moving on to the last slide. There are many other formulas that I could go through. These are the basic ones, and you'll see that just by using these formulas, these first 1, 2, 3, 4, 5, these 5 formulas, just by using them and by really analysing the accounts, you'll see in the next video how we can learn a lot from a company. Now, there are many other formulas. I can probably go through another 20 of them. If you're interested in learning all of them or learning more, then if you go over to my website, freebookkeepingaccounting.com, if you go to the blog, I'll do a blog post that goes along with these videos, and I'll go through all the ratios on that blog post for you, so you can go and have a look. Now, the ultimate key to analyzing financial statements, I prefer the word forensic accounting, because that's what we're trying to really do is be like a detective, but we're not necessarily looking for criminal sort of transactions or fraud, which forensic accounting is usually about. But I prefer that term. It sounds a lot more exciting. And it kind of describes what we're trying to do. If you act as a detective, if you try and analyze every figure and really look at the profit and loss and balance sheet, you'll be able to understand a lot about the company. These formulas really help, and you'll see how they help in the next video. But you'll also be able to see that if we just play detective a bit and really try and analyze and pull apart figures, then we'll be able to really understand what's happening in the company. Okay, this video has gone on very long. In the third and last video, I'll go through actually analyzing the example company accounts, and we'll make lots of notes. I'll show you how we can learn a lot from the company accounts by simply analyzing figures and using these 5 formulas that I've covered in this video. So I'll speak to you in the next video.